And in international news, Japanese stocks rose for the first time in 5 trading days after a panic sell-off after a 9.0 magnitude earthquake and following tsunami hit a nuclear power plant in the northeast of Japan. The Nikkei 225 index gained 5.7% to close at 9,093 points today. That is the largest intraday rise since 2009. Shares of car maker Toyota, for instance, jumped 9.1% in Tokyo. Sony Electronics rose 8.8%, and Futsuho Financial Group gained 5.4%. Analysts said previously people sold off equity in a panic and now buy back the shares. Should the issues concerning the Fukushima nuclear power plant be overcome or controlled, shares may even rise further, they added. The U.S. Federal Reserve kept interest rates near zero late Tuesday evening, despite increased signs that the U.S. economy is recovering. Even as consumer spending picks up and businesses grow more optimistic, the Fed is keeping its stimulus policy in place, including a $600 billion government bond buying program. Although food and energy prices spiked in the past weeks and months, the Fed is keeping the Fed funds rate near zero. Rates have been at this level since December 2008, but some experts disagree with the Fed's wait-and-see policy.
Well, they think that there's no rise in inflation expectations. I'm not sure what they're inhaling there at their meeting, but the whole world is well aware of the fact that we have inflation popping up everywhere, in China, in India, all over the United States.
That's not the only source of concern. The job market, the Fed said, was showing gradual improvement, still gives some experts a headache.
And the unemployment rate has been a source of confusion, and I think in part because the reduction in the unemployment statistic is largely a result of people leaving the workforce, not as a result of people being hired. And that still suggests a real sluggish economy.
European Union finance ministers have agreed on tougher rules against excessive borrowing and macroeconomic imbalances. The agreement marks another step towards helping to boost market confidence and end the EU sovereign debt crisis. After agreeing the framework for a new rescue fund, the ministers held 2 days of meetings to fine-tune the details. One of the main changes is tougher sanctions for countries who fail to balance their budget. The deal will be put to the vote next week at an EU summit, but economists say investors are still seeking more detail.
What's been agreed is broadly in line with what we anticipated would happen. It's a step on the road to the transfer union that basically ensures that the larger core countries will support the periphery. But there's still a lot of horse trading to be done. It's not entirely clear yet as to exactly what kind of compromises the smaller countries will have to make on things like corporate taxes, for example. And this whole episode is becoming extremely political.
And over in Mumbai, in India, US Wall Street bank Goldman Sachs agreed to buy Benchmark Asset Management, India's largest provider of index tracking funds, for an estimated $29 million. The transaction is expected to be completed later this year, but is subject to regulatory approval. Benchmark Asset Management oversaw 30 billion rupees, or $651 million in assets as of December 31st. That's it for international business. Before we head back to news, let's take a quick look at the Asian equity, commodity and currency markets. And after that, Laura Buckwell is back with the news.